Today, it's Edwin's Monday evening property rant. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Monday evening, Edwin is back. And Edwin, well, the interesting journey meandering along continues.
Martin, one thing's for sure, never, ever, ever, ever bet against the WeChat chatterers.
Absolutely right. Yes. The WeChat chatterers told us to prepare. It won't be a 10-day war. It looks like months. Well, yeah, here's another example, eh?
Well, this is it. And this is where it all comes back and ties down to property, which is what the rant is all about. It's all about what the landscape's going to look like potentially. I mean, don't forget, this is what the WeChat chatterers were telling us in January, the first days of January 2026. That's what my number 10 prediction has been. And we've been talking about it for the last couple of weeks. And that is that we need to be prepared. And then when this whole region started going up in flames, in the Middle East, it was already being discussed with the WeChat chat groups over in China. The tension that was going on there, but more to the point was also the South Pacific region. I mean that has the potential to become a very lively powder keg, and don't forget we've also had the rumors of the CCP, the Chinese moving into Taiwan, and I mean they're scaring the bejeebies out of the Taiwanese, and why not move when the world is distracted over in the Middle East. Now, what does that equate to us in regards to our property landscape, our property arena? Well, you got to understand one thing, and that's very simple. We've got hundreds and hundreds of thousands of expats that are abroad in these regions that have the potential to pick up stumps and come back. Now, it's not going to happen overnight because they've got to sell their assets over there in these regions in order to come back. Like I've said, for what's been happening in the Middle East with 130,000 expats that were residents there. All we need is 10%, 20%, however many percentage coming over, and it's going to put a buffer, put a mattress underneath some of these property markets that were wobbly because of the local issues. We have interest rate hikes, the cost of living pressures, and one of the markets that we're going to be keeping a very close eye on is going to be the top end, because that top end was wavering last year. But now with a lot of this coin coming back from abroad, these are people that aren't necessarily going to be living in your Mount Druids and your Schofields and your Box Hills and your Southwest regions, your Rabies and all these areas. They may go to Thurrool, they may go to the old stomping ground because you get some magnificent views from there, and they'll probably populate down there. I'd imagine because of the lifestyle. These are lifestyle people with a lot of coin, and this is why I keep on saying the Sydney siders and some of the commentators better put the big boy pants on and start getting real about what's happening. Yes, we do have a crisis. Yes, we do have a fuel crisis. Yes, we've got an energy crisis. Yes, we've got potentially interest rates going up. But we're not building anything. If we were building and we put a stop to immigration, well, then we got a game ball on our hands. But right now, I'm sticking to my predictions, regardless of what Louis Christopher does.
Well, fair enough. I actually made a show. I went yesterday, Will Australian Property Take a Bath? And I did relay there Louis Christopher's thoughts that prices in Sydney could fall around 5%, he thinks. And of course, there's a few articles flying around. The property market downturn gives buyers hope, and basically suggesting that brace for possible falls in prices in March. The auction clearance rates, according to Shane Oliver over at AMP, which he tracks with this chart, fell again. And in fact, I made this data built off the totality information that showed that the true clearance rates were down again. And just contextually, it's worth highlighting the fact that ownership in Australia, home ownership, it's gone pear-shaped. You look at it compared with where we were in 1990. The median home price 195,000, now 950,000, up 385%. The price to income ratio from 3.4 to 8.6%, and the first home age for buying 27 to 29, now 36 to 38, up 8 to 10 years. So you can basically say, yeah, there are some issues, and the property market is continuing to be extended and pretended for some people. But as you say, there's another angle here as well, and that other angle is these are additional people coming in, potentially well placed financially, and therefore perhaps going to buy, not everywhere, but selectively. And I think that's the point we always come back to. You need to look not just aggregate level, but you need to look at the granular level to really understand what's going on. Mind you, I have to say, Edwin, that however you look at it, inflation is definitely bubbling along. And I made a show about the inflation statistics last week. The inflation rates, they're talking about 5%, et cetera, et cetera. And of course, the petrol pain, followed by high price groceries, is likely to follow. And the RBA recently, Christopher Kent here, talking about the fact that probably hinting that rates will go up. And in fact, Westpac has now raised their expectation for 2 extra hikes to 4.85%, coming down later. But they're talking here, they're further ahead than some of the other banks. And it's interesting that CanStar just gave a bit of an update. If Westpac was right and you had a $600,000 mortgage, if you added all the increases together, we're looking at $457 a month on the average loan. So yeah, it's a definite significant pressure. But again, it's not the only part of the story. I'm trying to balance this. I think we have to get some balance in this. There is definitely a lot going on, but again, not uniformly. And I do think the WeChat chatters did tell us, and we are seeing it. The other angle I want to just step back, you've got to understand that the Iran situation is a microcosm of a much bigger battle between China and the US, effectively for future supremacy. And that's basically about the oil, who controls the oil, who controls the manufacturing sector and the tech, and how those things play out. And I think it's important not to lose sight of the Game of Thrones game that's actually sitting behind all of this. And in a way, what we're seeing in Iran and the oil crisis is just a small part of a much bigger, more strategic battle. And I think sometimes people forget about that.
This is something that I've been saying and talking to Dusty over the last week or so. We've been talking about the potential for why the war? What is it all? What is it all happening? I mean, I talked to my family abroad as well in South America and parts of North America, and like at the end of the day, it's dominance. It's energy dominance for the future. And there is no reason why. I said to Dusty last week, I said, there's no reason why we can't get our oil or diesel now from America. Yeah, it's a lot further to travel, but hey, that's what it's all about in my view. And we have to be weaned off the Chinese tit. Simply as that. Simply putting it, we have to be weaned off. I mean, we've become the dumping ground for Chinese. Even EVs and all these green energy stuff that's coming on. That sooner than later we've got to we've got to come to reality. And at the end of the day, we've got this situation right now where we're not energy independent because we've been relying and we've been pushing for this futuristic green energy and net zero by 2030 and so forth. And it's really put a lot of strain. So right now, the tide's gone out. And our governments have left with the pants, at the ankles, and this is and it's exposed a great issue that we have. So, but we've known this. We've known that the general public have known for decades where we were going. It's just the way that the governments have been leading us, and they've been sacrificing first-time buyers. They've been sacrificing the young. They've been sacrificing the new families with regard to trying to throw money at them to win votes to try and make it affordable for property, and all in the guise of giving them giving them hope and giving them vision, when in reality they've been the sacrificial lambs. They're the ones that are going to be suffering moving forward with the hikes, with the future potential hikes, with all the all these economic upheaval that we're facing right now. So we've got this situation where it's almost like, although the government feasts on the votes that they gather from the young people, they're also using them as cannon fodder, and they throw them under the bus when push comes to shove. And that's the unfortunate thing, Martin. And likewise, we've also, you mentioned earlier on, you said, there are certain segments of the property market that are going to suffer, and I agree with you. I totally agree with you. There are quite a number of areas in Sydney, in Sydney as well. And I'm not talking out in the out of Whoop Whoop, the back of Burke and all that. I'm talking about, there are some Sydney markets that will suffer, and they're already suffering. And what we can see is, we go back to, or why can we say this? Because we go back to the simple aspect of numbers. Numbers, tell the story. Everything else is just a lot of noise. So when we're looking in the Mid Mountains region for a client, towards the end of last year, October, November, there was 146, and we eventually got to 175, 77 homes listed on the market for sale. When you do a radius search from Lawson, currently there's 246. So what's happened in these markets? Why has this gone from 140 to 250, let's say, right? Why this sudden surge? Because what we've discussed before in the show, because of regulations around the Residential Tenancies Act, the regs, and the restrictions to short-term leasing and everything. So when you pick a market where you've got a high concentration of short-term leasing, and that's a market that's going to get affected. Now, it's taken all this time from the middle of last year to now to really start having that effect. We saw that part of that earlier last year when the regs came in. We saw that translate into real downward pressure on properties around Lura, in property prices around Lura. You could pick up a property in early to middle of last year, 2025, for the same price that people paid for it in 2021, 2022, Martin. And we shared this on the show. But now all that's moved further because it's affecting more. And as you said, the inflation cost, construction costs, renovation costs, material costs is biting into the investment groups that participate a lot in these short-term rentals in the in some of these outer region, or the outer regions of Sydney, or these lifestyle regions where where properties, because of the landscape, they wither away a lot quicker than your normal suburbs, because of the weather patterns, because of the surroundings, because of the moisture, you name it. There's also, and the way that were built as well, and the materials that they were built from, the runoffs. Similar to properties what you see happening in the Sutherland Shire, where they're built in those hilly areas, and also your old neck of the woods, Martin, in the Thurul, where you've got you've got piers on massive piers that, so I saw one house that had piers that were 3.5 high. I mean, that's pretty high for piers, and when you get a bit of movement, and you got all sorts of issues. So these are the markets that will suffer when those inflation figures start really biting. And potentially, this is where you're going to get a lot more property on the market, and the values are going to be pushed downward. But it's only certain markets, not all markets. And as I said earlier in the show, I mean, the expats coming back from your southeast, from your your Asia Pacific region or your Middle East region, they're not going to come back. They're not coming back here to park themselves in Mount Druitt, or to do TikTok videos on the Nepean River or Cabramatta Creek. That's they're the markets that are going to be. The markets that are going to be affected are your northern beaches and your eastern suburbs, by the water. Your lifestyle, high end stuff that's going to go up. So this is where we are, Martin, and this is why we take everything collectively, and we look at all the uh, indicators to give us a better understanding of where things are going. So right now, this is what the WeChat chatters are saying, and as you and I've said before, when they move, when they act, markets really move.
Yes, absolutely. And talking about markets moving or not, it's worth noting, I think, that the government has now decided to halve the fuel excise as part of a, quote, 4-stage national fuel security plan. That's, well, maybe some good news, maybe not. And there were some interesting reactions to it with regard to Alex Joyner, who said that the budget running an expected MAIFO, the cut to the fuel rebates, going to cost the budget $2.5 billion that will need to be saved somewhere else. And as Albanese said, we're halving the fuel tax for 3 months. Federal government will halve the national fuel excise, to cutting 26.3 cents off the fuel off the price of fuel. Interestingly, for other people saying, well, hang on a moment, the mining companies get massive amounts of support already, right? They use 24% of our diesel fuel and receive significant fuel credits, rebates for diesel used in off-road mining. Just put that in context. And as Simon Holmes a court said, well, congratulations, punters, for 3 months you'll get a half discount on fuel excise. I support fuel excise exemptions for farmers and small businesses, but any business claiming they need more than $50 million in exemptions is having a lend at taxpayers. And that's really the point, right? So you've got to think about, when I saw it, I thought, here we go again. This is the COVID playbook. Got to throw some more public money. Now, I know it's a problem, and I know that fuel price rises, have a significant impact, but we don't know how long this is going to go on for. And we actually don't know what the true economic impact will be. I'm looking at a few other indicators. For example, if you look at the jet fuel prices, the ones in Europe, they've surged massively. So we're going to see significant airline increases. Are the airlines going to be supported too? And how far do you go with government largesse to try and actually get by? Some of the issues we got in Australia is because of poor policy over the last 20, 30 years in terms of not holding enough oil on shore and being too reliant on a small number of supply chains, and shutting down local manufacturing as well, particularly for refining, but also other things too. And I stand back, and I made a show the other day saying, well, actually, I think we're now, the markets are in correction territory, and there's no real place to hide. It's not just Australia. This is the diesel price since the Iran conflict, and you can see there that in Australia, it's up 52.1%. In Philippines, up 81.6%, and they've already pushed some significant measures there to try and link the circle back to the Philippines from earlier on. And it's just worth highlighting the OECD and the University of Michigan are talking about higher inflation expectations. This is the University of Michigan, so economic outlook falls and inflation expectations are up. But just to go back to the diesel situation, Australia, on average, consumes, if you look at it, 7.7 barrels of diesel per person each year, more than any other major economy. We are so exposed in Australia. And it's interesting that when you look at the different industries, well, forestry, as you'd expect, airline transport, road transport, and the coal mining, gas production, and iron ore extraction also rank among the top 10 most fuel-hungry sectors. And so there you go. It is an interesting contention. My worry, though, Edwin, is we are defaulting back to the same mode where government debt's going to continue to rise. That's going to put more upward pressure on interest rates. That's going to put more pressure on taxes ultimately. And so it may smooth out the bump in the short term politically, but longer term, it could be a more significant pressure point on the economy. And I really am worried that we are meandering into this future when more and more of the country is just supported by taxpayer money. And where does that end?
Bismarck, no, I propose two things, right? The first one is let's set up a committee. Let's set up a committee and a think tank, and yeah, let's think about it for the next few months. And but we need to be the committee needs to be subsidised to the tune of yeah, at least 200 or 300 million dollars, so we can come up with some ideas. Right? That's the first thought. That's the first thing that's going to happen. The second thing, is I put it to you, Martin. I put it to you. Why don't we give the EU sheep, and we get renters? How's that? Yeah, do you think? I reckon that'll really solve the housing crisis. What do you think?
Wow, it's just amazing. Of course, we just had the EU agreement with Australia, and it does almost see as though EU citizens will potentially have more rights to live and work in Australia, not age restricted and for longer time, than British people do under Johnson's rushed out and botched deal. Yeah, it is pretty amazing. And I don't know about you, but I'm quite skeptical of the efficacy of these trade deals. It always seems to me that you end up, maybe benefiting a little bit over here, but you're having to give a lot over there. And actually, the critical point, do you know, Chalmers has pretty much confirmed that migration is going to go up. So his strategy is bring more people in. Come on, let's have some more people, please, because that's the only lever. Well, of course, that's going to help, isn't it? But except that we aren't building enough. And by the way, as we'll come on to a second, the cost of building has gone through the roof too.
This is the thing, right? This is, yeah. Tell me you don't want to pop the property market without telling me. And yeah, secondly, I'm just hoping that maybe amongst all the people that are going to be coming over from from Europe, some of them will bring the tool belts and hammers and nail guns and tug along. But look, at the end of the day, ever since I can remember, in traveling all around, driving almost to the tip of Queensland regularly, and also down to Victoria in my younger days, and in Adelaide. It's we do have a very big country, and a lot. We are very highly dependent on trucking, because any other type of infrastructure is just non-existent. How long have we been trying to build the infrastructure through the back, through parks, to marry up Queensland with Victoria and have the pit stop in parks? How long's that been going on for? That's been going on for about 30 years, and people were investing in parks because of the big hurrah of the big depot that was going to be built there. I mean, I think something's happening at the moment. It's got to be happening because Aldi's moved in there about 5 or 6 years ago, so something's got to be happening. So this is in essence. Look, I don't. I am a believer, and I'll be straight up. I am a believer that we do need to increase our population. But I'm also a believer that the type of migrant that we need to bring into the country, and let's not forget, and look, I'm being straight up here, right? So I mean, I had no choice when I was 8 years old. When my mum and dad said we're going to Australia, I said, what the hell is that? Where's that? And then my father at that time, we got bought over by the government because he was a skilled, a skilled, metalwork, what's known as a boilermaker engineer, in that field, and he worked in the oil rigs, and so he was a skilled, come over the skilled migration back in 1974, and the family got paid for to come over. Now, that type of migration, I'm all for it. But when you start bringing in students upon students upon students, just to fatten the wallets of the chancellors and the vice chancellors that make upwards of $1 million a year, I mean, that's a different story. because what are they doing? What are they building? They're not building anything other than it's a drain on the taxpayer, as you said, because we're supporting the universities on top of the fees that they get from the people on board, and all these dodgy degrees that they get. I mean, this is where things have gone wrong. So, look, I'm all for immigration, but the right type of immigration, the right type of controls put in place that we've you know we've dismissed for decades, and here we are when we should have been building more infrastructure out in out west, northwest, west, and southwest regions, so that there won't be such a strain on your central hubs. But this is where we are. As I've shared before, there was a planning going around. I think it was when Neville Rant was in office, and Orange was going to be basically the second biggest city of New South Wales. I mean, that would have been a hoot. That would have been brought so much into the region. I mean, Orange is cranking now with the hospital infrastructure that's happening there, and all the specialist fields that are moving there, and the lifestyle that you see there. I mean, and that is what's driving the populations there. That is what's driving these. That's how the sands are moving. The sands are shifting to these hubs where they've got something to offer. In particular, where they've got something to offer for the Asian population, because it is aging population, because it's getting more and more expensive to get older, man. So this is and so when you've got these in Orange, you'd be lucky to find a freestanding home for a decent freestanding home for under $1 million, and we're talking about Orange. We're not even we're not talking about Sydney. We're talking about Orange, Bathurst. So these, but as these towns grow, hopefully there'll be more infrastructure in there as well, and because it is the right infrastructure that pulls in people from but at the moment, the pressure that's being felt in Sydney is predominantly by the wrong form of migration policies, whereas the infrastructure that's being built in your Oranges, in your Bathursts, and in the other regions of the New South Wales is more migratory from the state itself, from the smaller towns that can't survive anymore because the banking infrastructure is absolutely decimated. They've got no banking. They can't do business. The pub shuts, and that's it. It becomes a ghost town. So this is this is where planning has gone absolutely wrong. So going back to my original point, do we need more people to come into Australia? I believe so, but it's got to be the right type of migrants that we pull in. That's I felt that's how I feel. That's what I think. If we could, we'd swap 50% of the ones that are here with be glad to bring in more people from the UE. That have got a trade background.
Well, I think the critical issue is you can plan for a bigger society and you can plan for more migration coming in if you select the right types of migrants. I agree. But you got to have the planning on the supply side as well. So, how much property are we building versus what we need to build to be able to actually meet the demand from those people? Are we putting in the right place? And what about the infrastructure, hospitals and schools and everything else? And unfortunately, what we've done is we've turned the tap up, bring anybody in, we don't care, mostly students, as you say, and then some of them hang around and some of them don't hang around. But we're not necessarily being that selective in terms of the types that are coming in, but we're not actually responding on the supply side too. But what we are doing is to effectively build more expensive, luxury apartments. And this article made the point that, the luxury apartment prices are jumping by $125,000 as war sends building costs soaring. But that's not the stuff we should be building. That doesn't actually solve the problem. It's not luxury apartments that we need more of. It's actually good, solid housing in the right areas to be able to meet the demand that we've got. And so, once again, we've got the economics and the strategy completely misplaced with what we need to be able to actually build. So, if you look at the history of Australia, Australia was built on migration, very strong migration, but it was also built on very significant public investment as well as private investment in the infrastructure that was needed to be able to support it growing. And it seemed to me that we lost our way probably about 35 years ago, and we started to decouple the supply side strategies with the migration strategies. And then, of course, we had the recent boom in migration. It's 300,000 plus over the last 12 months of migrants, according to the latest data that's officially available, although actually some of that data might be a bit delayed and, I'm not sure exactly where we are now. But it's a policy failure, isn't it, really? It's a failure at both state and federal level to join the dots.
Question to you, Martin: is a policy failure per se, or on face value, or was this the intention all along? Let's not forget that a student brings in $40,000 per year to the coffers of the tertiary education institution. That's what they're paying. Upwards of $20, $30, $40,000 you extrapolate that over 3 years, and then the government gives them 3 years plus 2 more, or 4 years plus 3 more, or 5 years plus 6 more years to be able to work before they get sent back home. And a lot of them obviously apply for residency under all sorts of pathways. So from asylum to whatever else. So I say to you again, Martin, is it really failure, or is it or is it more orchestrated? And this is what they wanted all along, because of the money that these students brought in. Now, whether they come from India, whether they come from Pakistan, Sri Lanka, Indonesia, wherever. They're stumping $20,000 at a minimum per year to attend these tertiary education, or these colleges. So that's the first thing. In terms of what we're building, I mean, they've got it totally wrong. But why? Why are they? We obviously can't build what we should be building, and it's not so much what the government wants us to build, or when you look at what's affordable for people to buy, but we're not really building what people want to buy or move into, which is your freestanding homes, at worst a townhouse or a villa. That's what young families are really wanting. But when you start building your high rise, why did we go high rise in from 2012 onwards, when the Foreign Investment Review Board watered down its policy, not to sell more than 22% of the units in an apartment complex to foreign investors? What? Because of the fix, because of the stamp duty fix. Once you get a crackhead on meth, I mean, it's very difficult to take them off it, or cocaine or whatever, or crack. When you got a junkie on crack or cocaine, I mean, that's the crack and the cocaine. Stamp duty is the crack and the cocaine for the state government coffers, and and federal government taxes, the GSCs that they collect from and every other impost that they collect from builders and developers. So this is why developers and builders can only build your luxury apartments. They can't build normal, because they're not making money out of normal builds at the moment. Not at the figures that we're talking about. The general public aren't prepared to pay $1.3 million for a 2-bedroom apartment in Blacktown, or in Mount Druitt, or in St Mary's. That's just not happening at the moment. But this is the scary thing moving forward, Martin, right? And this is what I've said before, and that is, once the sharks, that once they get a taste of blood in the water, do you really think that they're going to go back to the old prices? They're not. the prices of construction, the prices of materials, and that aren't going to pull back anytime soon. And if they do, it'll be minuscule in comparison to the 35% increase in PVC from that the notices were sent out to all builders, developers, and plumbers around the place. And yeah, today, we started the demolition of a renovation that we're doing at Kings Park for some clients, and the I got a skipping dropped off, and I was talking to the truck driver, and he said, "Matt, it's a good thing you ordered this last week because today they increased the fees, and by the way." Got to get this filled and and sent to the you know sent the to the depot ASAP because the tipping fees are going to increase by another 27% by the end of the week because there's a lot of machinery that they're running there, and a lot of the machinery that they runs on diesel. So 27%. When you're already paying over $400 per ton, that's just the tipping fee. That's not the skip and the pickup and the delivery, the drop off, and everything else. I mean, it all adds up. So, but the problem that I see moving forward, Martin, is even if this war stopped, even if this war came to an end and ceasefire altogether, over the next week or 2 weeks, do you honestly think? And I ask the viewers and our followers the question: do we really believe that the sharks and the piranha are going to pull the prices back? I don't think so.
I tend to agree, Edwin. In fact, if you do the sort of the bottom-up calculation of what it actually costs to build and include all the taxes and everything else that the developers have to pay and everything else, the interest costs, when you actually sort of add it up, you start getting a big number. And that big number isn't necessarily going to drop. It's going to hang around and perhaps go sideways rather than continue to rise dramatically. But no, that's one of the problems we've got, is that the costs of building new continues to accelerate away, and that then tends to lift all boats, right? Because that means the rest of the property market is also going to be responding to where the price of new is. So I think that's one to watch. Another one to watch is this question of strata fees, and very importantly, the strata managers and the commissions that they actually are getting quite often. It's interesting that according to the New South Wales government here, ending commissions for strata managers could save New South Wales $333 million over 15 years. Oh dear. This is one that you and I have been on about for a long, long time, Edwin. The truth is that there are quite a few kickbacks within the strata system that is actually corrupting the whole strata system.
These are the ones that the Fair Trade in New South Wales know about, which is predominantly your insurance kickbacks that the insurance companies give back the strata companies, which they got found out about 3 years ago. But I've been banging on and I've been going toe to toe with strata companies. Uh, when we were running the property management portfolios for a lot of investors that had investments across Sydney in many complexes. So I got to go toe to toe with quite a number of strata companies because we knew for a fact that that would get kickbacks anywhere from 5% was on the low, 5% to 20% on any trade service that were being provided by the preferred tradespeople to undertake any rectification work or any works that were required to be done for maintenance, or ongoing maintenance of the complex in order to meet to meet the fiduciary duties, as strata companies. So now, and this isn't sort of taken out from the fee that the tradesperson would normally charge. This was baked on top of what the price that they already gave, and they were in a lot of the cases weren't cheap, and we challenged them over and over and over and over again, and Dusty was only telling me yesterday that last week, she was hearing a lot of matters in the tribunal around people taking strata companies to the tribunal and to hear cases because I mean some of the repairs and maintenance works were horrendous, to get done. But as I was saying to Dusty today, when I was talking to her today, I was saying to her, one of the things that you've also got to keep in mind when you're in the tribunal and talking to the different people, in the clients that she helps out at when they've got tribunal matters, is that you got to be conscious and cautious of the fact that some of these specialized materials have quadrupled in price over the last 6 months. Some of the waterproofing materials that are required to do the rectification work in your uh, uh, high-rise apartment complexes. I mean, you're paying the material alone. You're paying close to $18,000 just for the material to undertake the rectification work of a leaking balcony. You only have to multiply that by 10, 20, or 30, and that's just material margin. So this is why, last year, if you recall, the middle to the last quarter last year, we shared about some of those rising costs in rectification work in this high rise. This is what people need to be very, very aware of, is that it's not only the specialized materials that they use in your high rise developments that are deemed to be the the appropriate materials to use moving forward in order to prevent ongoing issues. Um, you know, it's a different kettle of fish when you're dealing with when you're doing works in a house to a high rise development. There's all sorts of different factors, and everything costs a lot in the works. I mean, and I shared back then that I know a level 2 builder that's charging upwards of $65 to $85,000 to rectify leaking balconies in high-rise developments, and this is the developer that built this complex is the one that's footing the bill. That's paying it. So it's nothing out of the ordinary to be paying that kind of money. Because I was gobsmacked, if you recall, when I was sharing that story as well. And this is what I was saying to Dusty. Now, bake on more cost, bake on energy issues that we're going through now. And you add and you add and you add and you add, and but you bring in more. You start trading sheep for renters, and you start doing all these funny bits on the side. And this is why I'm still, somewhat bullish about quite a number of the property markets in Sydney. And Louis Christopher still, can't change my mind otherwise. But as you and I say, it's a top view from what Louis gives us, but what we have and what we share and what we look at, particularly with our clients, is more granular look, and also with the stuff that you do with your clients when they want an overview of an area, which is what you really need. Because when you start drilling down and understanding costs, future costs, and you start comparing more so with your clients that are looking at investing in particular styles of properties, but you've got to be ever so careful. And, so really, you really need to take a deep breath and just take a step back and just stay calm and before you move forward.
Well, the point is, Edwin, there isn't such a thing as an average house price, is there really? I mean, it's, if you think about the markets, every market is different. Within that, every market, there's a gradation of low to high prices. They're moving dynamically. And so when you sort of aggregate them up and aggregate them up and aggregate them up, you end up with a total number that's completely meaningless. And that's why it's important to really go very, very granular and look at the local situation, look at the local need, and all of those things. And if you do that, then you get a very different perspective. And going granular, I think, is what we keep saying on this show. And it's so critical, and it's even more critical now because I can still point to areas, not just in Sydney, but in other places as well, where prices are rising. But I can also significantly highlight now prices going down in some areas. But again, it depends on which type of property you look at, where you look, and the characteristics. Now, it's interesting, Edwin, that the New South Wales fair trading inspectors have told us, wait for it, they're going to increase the checks at residential property auctions to help ensure the auctions are being run fairly and in line with the law. Da, 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 da. Well, what do you think? I'm a bit
Look, I'm
skeptical
not.
personally.
Yeah, yeah. So am I. But look, it's good noise. It's good noise, and it will continue to just be noise until we actually start seeing people taken to task and they start publishing some real fines. If they ever get prosecuted. Uh, I was at an auction last week. We shared the auction on the show, and if people follow my X handle, they'll see there. I've also posted it on LinkedIn, scaring the industry a little bit there on LinkedIn. With where you got a property with a price guide of 1.4 million, and then they pass it in at 1.5. But the thing is, I've got a hold of the agency agreement, and you can see that the agent gave an appraisal of 1.5 to 1.6, but yet they've been guiding at a 1.4. So this is the shit that goes on, and as I said a couple of shows ago, the industry needs to back and support this as an industry, and I likened it onto the way that the Vietnamese people kicked out the T5 gangs from Cabramatta and made it a great place where you can feel safe and go in there and have good fur and everything else there and enjoy the charm and the aspect of the Vietnamese community there and all that they have to offer in the by way of the restaurants and the hospitality that they provide there. But it wasn't but for the community itself that got rid of the vagrancy, and this is where the industry has to rally and get rid of the vagrancy. We have to get rid of that vagrancy ourselves. So, this is the stuff that's going on. But let's wait and see. I'm not holding my breath, and it's not until we actually see some names plastered on the Fair Trade New South Wales New South Wales website, um, that of suspended licenses or fines that were issued over $100,000 for a continual uh, you know for the recalcitrantry and for the continual abuse of the goodwill of the people by underquoting. Well, then until we see that, until that's published, I'll hold my judgment. I'll remain as skeptical as you.
Yeah, well, we are skeptics here, aren't we? But I will just say one thing. The fact that fair trading says buying or selling a home is a major decision, and through these checks, we're helping to make sure the process is transparent for all. So, absolutely, it is a big decision, and absolutely, transparency is what we're about too, trying to help people understand more about what's going on. So, in a way, maybe fair trading is actually beginning to get the drift. So, we'll see how it plays out. But in another little angle here, which I just want to touch on, Edwin, the truth is that tradies are the new playboys, right? So if you actually don't bother to go to university or get a college degree, just become a tradie. That's where the future lies.
Yeah, look, it's you had your TikTok influencers, you had your Dubai UAE is underwater now, so now your next option is become a tradie. But I've been saying this for about 15 or almost 20 years that if I could come back as when I come back into the world, I want to come back as a carpenter slash plumber. Hit the ground running, and you got the best of all worlds. But then look, there are some teams, there are some trades teams that I know uh, that the owners of they'll put on they'll have the what do they call the uh, age apprentice, what we would call them, mature apprentice. But you just got to be prepared to. You just got to be prepared uh, to accept a low wage for the first 4 years, and depend on what type of apprenticeship you take on, whether it's carpentry. I mean, you really wouldn't want to be a plumber because those poor bastards, they have to do 6 years, especially if you want to also do gas. Play around with gas. But hey, at the end of the day, the rewards are there. So the choice is for the young people. The choice is, I think, moving forward. And when you start looking at what AI, is going to do, and we're going to see a huge shift from the white collar workers, a huge downturn in terms of their job prospects because at the end of the day, they taught AI, and a lot of these engineers taught AI to do the job. So they went hell for leather, teaching the artificial intelligence to take over the job, unbeknownst to them. And then they get called in, they get a conference call, and AI sends them a message saying, "Hey, you don't bother to coming in tomorrow because your office doesn't exist anymore. Your position doesn't exist." So it's going to be an interesting shift of wealth. But we've seen this play out, as we said before, in the great rehearsal, the great Chinese rehearsal. We saw it play out also in the great Japanese rehearsal. The difference with the great Japanese rehearsal was that the government was supporting small business operators, whereas in China they chose not to. They just chose to print money, more money. In Australia, just following the lead, the Chinese lead, rather than supporting the SMEs. They're all you're going hell for leather, printing more money and relying more on and putting the squeeze more on the small, small to medium enterprises, which is what you said earlier on. This is where how long can the small to medium enterprises support, the huge, top heavy infrastructure that's made up of the public service.
Yeah, well, it does beg the question, doesn't it, how this is all going to play out? And I think the point about AI is that, yes, some of those white collar jobs that were last time around seen as relatively secure suddenly don't seem secure. In fact, in financial services, we're seeing quite a lot of them beginning to disappear now as AI sort of takes over, and call centers and support roles of various sorts. But maybe using the tools and being able to fix things, well, in the current environment, being able to fix your own things could be quite useful. Now, there's another little angle I wanted to explore with you, Edwin, and this was an interesting comment from one of Australia's richest women, Serena Rosso, who has evidently slammed Aussies who complain about the cost of living and basically told them they should pick up a second or a third job to make ends meet. And it reminded me of years ago, there was a politician in the UK who basically said, you should get on your bike, go and find a job, there's jobs if you go look. So we do seem to be in the situation where some of those people who are fortunate to be quite wealthy seem to be able to diagnose the problem of everybody else. But I feel often they are frankly losing touch with reality. Many people are up against it. Many people are already working multiple jobs, as in my surveys. And of course, with the cost of living continuing to rise and with the inflation now higher, that's a problem. And the other point, as we were saying with the AI thing and jobs changing there as well, maybe a bit more difficult. So I felt that this was a bit of a sort of a disconnect from reality.
Yeah. And that's why when I saw that post as well, I sent you the Daryl Hall and John Oates, picture there. They got a great song, Out of Touch. I sent it to the social media link that posted that article there. So hopefully it gets to Serena somehow. No out of touches. But look, isn't it the case that, as you said, there's a politician in England, and there was also a famous real estate institute of New South Wales president, and who also became the real estate institute of president of the Real Estate Institute of Australia. That also told young people, if you can't afford a home, go out and get a second job. So and these are people. But let's not forget that him and his wife also we've been prosecuted for dealing with trust funds of I think it was on or about $320,000 or $360,000. But their excuse was, well, hey, we put it back. So that's how out of touch these people are. Once you get to a certain position, you lose touch. You lose touch with with the reality. And the unfortunate thing is that a lot of the politicians are flying the same kite, or they're drinking the same Kool-Aid, because it's all, it seems to be always, or most of the time it seems to be, do as I say, not as I do. I mean, there's figures floating around of the uh, the expenditure of private jets and everything else. I mean, from our politicians, during this fuel crisis, when some of them can actually, stay. Don't they get some sort of boarding over in Canberra as well? So why can't they stay there for a few more days rather than commuting backwards and forwards from their state?
Well, I put it in the same bucket as the smashed avocado being the reason why people can't afford houses, right? So if you didn't go out to the restaurants all the time and have smashed avocado, you'd be able to save more, and that would actually allow you to buy a property. It is disingenuous, actually, for those people trying to get on the property ladder. And it shows you just how out of touch a lot of our senior people, whether they be CEOs of companies or whether they be senior politicians, because they get, largesse left, right, and centre. And it's a completely different world. But the real world for ordinary people is looking quite dark at the moment. And with everything that I'm seeing at the moment with the higher interest rates, I think we're going to see more pressures. So, yeah, I just out of touch, I think, is the polite way of putting it. But if I was not doing this on YouTube, I might be more rude. Let's just look at the.
Let it go. Let it rip, man. Come on. Let it
Oh,
rip.
no. I'm way too refined, Edwin. Way too refined. Let's look at the numbers, though, now as we come towards the end of the show. So, on the domain definition of the Sydney region on the 23rd, there were 22,806 properties listed for sale on domain. And if we go forward a week to the 30th, 22,734. And your chart begins to highlight what we've been seeing is that the listing story is beginning to change, despite the fact we had a really big auction night or day on Saturday. It does seem to me that more people are beginning to get a little bit coy and perhaps taking properties off. But I don't know, what do you see?
Things that I noticed with the listing, and I looked at also the land envelope sales, right? So they increased from last week to this week quite a lot, by about 400 lots. So we got to be careful not to conflate or not to add the land sales onto the actual established homes, or ones that are being being sold off the plan. We have had a rise. Last week we saw a drop below 2025 figures. Now we've picked it up again, but it's not like it's surged like the media is telling us. I believe it's because properties are lingering on market a lot longer, but I'm still of the opinion that post Easter, Martin, and we'll see if I'm right or wrong, but post Easter, we're going to see drops below the 2025 figures, because again, the uncertainty, global uncertainty, will create the general tendency for the planners are going to be to take the listings off and wait it out, and perhaps wait it out over winter to get into spring. Now, if we end up with lockdowns, so these fuel lockdowns, as the people are calling, if we end up with some sort of some sort of restriction of movement, and that, then you can bet your bottom dollar that a lot will just pull properties off the market because they're not going to get. They will feel that they're not going to get the same exposure that they would otherwise get if people were free to drive around, check the properties, and get greater bodies through the place in order to get a better value. So that's my call. But we just got to wait until the post Easter. But again, we go back to our old saying, and that is different markets will act differently because not every market in Sydney has had this deluge of new listings like I've seen in some parts. Yeah, there were some parts of some suburbs in the Blacktown region that the listing numbers haven't gone up. But where you look at your Bella Vista at the beginning of the year, there was only 3 or 4 listings. Now there's something like 12 in your older part of Bella Vista. So these are the again, different markets are going to be reacting totally different, and we go back to why, and that goes to schools, places of worship, amenities, health facilities, especially for the elderly, and so it's caution moving forward. Just wait it out, have your holiday and wait it out till after Easter.
Yeah, I think we'll see how it plays out and how much more the disastrous the fuel thing plays into this as well. Of course, if, as you say, if we get into a sort of a pre-COVID situation again, where in fact more people are actually being told not to travel, that'll have a depressing effect too. But certainly, the other interesting observation that you make about location, schools, amenities, they are really quite important for people. The other thing I'm seeing more of as I have these one-on-one conversations is people are getting more aware of the planning changes, and particularly these rezoning that's going on at the moment. And that's actually now becoming quite a conversation point in my one-to-one conversations. So in fact, people are getting a little bit more alert to the fact that you've also got to again go granular on the planning side too. I think that's a good observation, I think. Let's look at Melbourne. So Melbourne on the 23rd, 30,486. A week later, 30,596. So a slight rise again. And if you compare that with Brisbane, 3,110 on the 23rd and 3,102 a week later. So a very slight fall in Brisbane. And looking at the auctions, well, it was a big week last time around. I guess the question is, we're coming up to Easter, so it's going to be presumably quiet over the Easter weekend ahead. And after that, well, I guess perhaps all bets are off, depending on what happens with some of the other issues we've been talking about.
The midweek, obviously, Easter long weekend. As we said last week, the reason why we got a huge rise in a spike was because everybody was trying to beat the Easter long weekend and put the property on. They didn't do too well. Again, if things start to things are going to seasonally, they're going to slow down a little bit as we get into winter. And depending on what happens after Easter, with the fuel and lockdowns or restrictions and everything else, again, and the other thing that people are really are not understanding is that a lot of the failure of the auctions at the moment is it's not so much the prices or the buyers aren't there; it's that the buyers will not pay the inflated expectations that vendors are expecting because there's got to be a lot more demand than supply in some of these auction preferred areas. Then there, because it's, as I said, it's very difficult to try and to be the first to break those new price ceilings. So it's not until we really see the aftermath of what's happening in the Middle East and if things heat up in the Asia Pacific region, people with a lot more money coming in, then you'll see a lot greater pickup. But for now, it's really sort of flattening in a lot of the markets in those markets because it's everybody's playing the wait and see game.
Absolutely. And this is the chart that just shows you the listings comparisons 24, 25, 26. And you can see there that, as we said, big peak over the last weekend, then a very small go now. And ahead, I suppose, Edwin, it's a matter of wait and see. I will just make the point that we did have one viewer contact me and say, when I do the same calculations Edwin does, I get a different number, but you've got a particular source that you use for the data that you share, which may be a little bit different from the public available portal information.
Well, we use look, the data that we get for the auctions to do these chart these graph or auction graphs is public, and what they do is they scrape the data from domain. So it's the auctions listed on domain. If you scrape the auctions that are listed on REA, you might get you'll get a different number because REA they define the Sydney region almost all the way down to Wollongong.
Yep.
And almost all the way up to Gosford and over to Lithgow. That is not the Sydney region. The reason why we've been using the Sydney region because it's more defined, it's more concise it's more compact. So, and we've just been consistently using this for the last, 4.5 years that we've been sharing this data this way. Even before I was always comparing, when we do our searches for properties on the internet for our clients and that obviously we gravitate more towards REA because REA, you could say that there's about anywhere between 5 to 7% more listings on REA than you find on domain because because they pick up the the fringes also than others, and there are still some agents that there's a handful of agencies that I know that are just adamant with they still use only real estate. They don't particularly go on domain for each to their own. They just rely on there. That's why you get a difference. So I haven't. I mean, it's just been easier. And this other, like I said, this other website where we get our information from, where they get that, because I know that they've been scraping the data from domain for 10 years or over 10 years. So that's why there may be the discrepancies that the viewer's talking about.
Okay, very interesting. Yeah, and it goes to show that, Dan lies in statistics, right? So it's important to understand the sources and the assumptions. Just on the rentals, if you look at Sydney on the 23rd, 8,751. A week later, 8,742. So a very small fall. In Melbourne, 9,738 on the 23rd, compared with 9,635 on the 30th. So a bit more of a fall. And again, Edwin, I think in the current environment, the rental story is going to be one of, unfortunately, continued rental rises. There's a bunch of reasons. Higher interest rates, that's going to put more pressure on property investors to put the rents up. We're still seeing more rentals for existing agreements looking to be incremented up as well. So it's still a very, very significant pressure on many people trying to find somewhere to live. And now with the latest concerns with regards to the higher interest rates, that's going to put more pressure. I also want to say, I think that some of those first-time buyer 5% loan people who were expecting rates to come down, they're beginning to look quite scared now. Because if in fact prices do begin to slide, as they may well do in some of those first-time buyer areas, then as well as the big increment because of the higher interest rates, you could actually see that 5% getting nibbled away. And I wonder whether the government's now getting a bit nervous with regard to its own now exposure. If rates do force prices down, well, then suddenly some of the government support that was probably cheap to provide could be quite expensive to provide. So we'll see about that. Now, as we come to the end of the show, Edwin, a rather important but also rather a disturbing tip for this week.
I think just looking at it in retrospect, the last month or so, I've just started noticing, and they're pretty much all tips that we shared at if you recall, during at the beginning of the lockdowns, and because this is what we're seeing now playing out. And when I write this down, as I was preparing for tonight, and I wrote it down, and it's don't trouble alone. People do stupid things when they are desperate, and this is why I say don't travel alone. And I started thinking about our tip from years ago when we were talking about when you're in shopping centres, don't don't go to shopping centres on your own, because desperate people will do desperate things. So you need to be vigilant. You need to be aware of where you are, of your surrounds, and you know it's So therefore, it's safe to say try not to as much. Don't travel alone, and these because uh, people are getting desperate.
Mm.
People are getting desperate, and this would perhaps resonate more to our followers down in Melbourne, and then more so down in Melbourne than here. But then again, all the things that are happening from the local news places around the different parts as we drive around and talk to the different agents and property managers around Sydney. There's some scary stuff there, and this is why one of the main offices that I deal with and we worked with for quite a number of years. They will not send their property managers out on their own. It's just becoming too hazardous to send property managers to do any form of inspection or any form of discussion with tenants, because of the pressure that people are around there. And this is where it's going to unravel, and going to has the potential to unravel very quickly. And many that they get in the way, because there's a lot of tension, there's a lot of anger, there's so much out there which the government keeps on pushing under sweeping under the carpet, as they say.
Yeah, good point, Edwin. And I think people, do take care, and keep your wits about you. I think is the way I think about it, particularly now. Edwin, very important conversation as always. Thank you very much for putting all the notes together. And well, I guess we'll do it all again now. Next week, of course, it's Easter week, but I think we're still going to do a Monday.
Definitely, we keep on going. Yes.
Absolutely, and I think there might be a clock change as well sometime soon. So we'll deal with that. Anyway, we'll be back next week, and we'll continue to relay the latest and greatest with regard to the property market. If you've liked the show, please like and share, and also check out our socials. Edwin does a lot with his various socials, and he's actually putting up a little clips or things from the show on his channel as well. So that's sharing the message further. So we'll look forward to more of that. Edwin, take care. See you soon, and have a good week.
Come on, all the best. Yeah.
Cheers.